So if you think the markets are going to go up, what are you going to do? You're going to buy call option. And if you think the markets are going to go down, what are you going to do? You're obviously going to buy put options, right? But if you look at the historical data of Nifty 50, what you will get to know? You'll get to know that the Nifty 50 stays range bounded almost 70 to 75% of the time. So you might be wondering, I know the data says that the market is going to be range bounded 70 to 75% of the time. The analysis also says that the market might stay range bounded for a while. So you might say, okay, the markets are going to stay range bounded for a while. So which is that one strategy that will help me benefit from this range bounded market? And the answer for your question could be Iron Condor. So Iron Condor could be the best strategy to execute when you think the markets are going to be in a range or the market is going to be range bounded for a while. So what is an Iron Condor trading strategy? Iron Condor is an option trading strategy consisting of 2 puts and 2 calls. So in the 2 puts, one would be short and one would be long, and same in the case of call option, one would be short and one would be long. So there are going to be 4 strike prices and all of them will be of same expiration date. So the first thing that you are going to do in this strategy is picking a range. So first you are going to choose a range where you think the stock might stay in this particular range. It's like saying, I think the stock might stay between this number to that number. So for example, now you're on the Bank Nifty chart and you can see the Bank Nifty is now trading at around 48,268 rupees. So what I think here is the Bank Nifty might stay in this particular range, which is 48,800 and 47,800 for the upcoming week. So I think the Bank Nifty might be in this particular range and be range bounded for the upcoming week. So this is how you pick a range. So this is like betting on the stability of the stock or a market. And Iron Condor is like saying that I bet this stock won't fly too high or drive too low. So after picking a range, what you have to do, you have to create a wings for your Iron Condor. So you're basically going to create a call spread above your range and you're also going to create a put spread below the put option you sold. So this was the range you picked earlier. You think the Bank Nifty might stay in this range for the upcoming week, right? So now you are going to create a call spread and a put spread. So here I'll be choosing an upper range. So here I'll be choosing 49,300. So I'll change it to 49,300. And below here I'll be choosing 47,300. 47,300. And I'll change the color to white. And here also I'll change the color to white. So as you can see, this was the range you picked that you think the market might be in this particular range, but these 2 legs are basically acting like a stop loss, or it's basically going to help you protect your capital from any directional move or any strong directional move. So after selling options to the other trader, what are you going to receive? You're obviously going to receive premium. So that premium would be your profit in this particular trading strategy. So if the market stays range bounded, then the premium you received will be your potential profit in this particular Iron Condor trading strategy. So after executing the strategy, what you have to do, you have to just wait and watch. As long as the stock or the indices stays in your range until a certain date, then you can keep the premium you collected. So now let us discuss what are the advantages and disadvantages of this Iron Condor option trading strategy. Obviously, the first advantage would be that you can make returns if the market stays sideways or if the market stays range bounded. Even if the price doesn't move much, you can make a decent return from this Iron Condor option trading strategy. And the next advantage could be defined risk. So you know your potential losses. So your potential losses are limited, which makes it relatively safer strategy compared to some other strategy in the market. And if we were to talk about the disadvantages in the strategy, then the first disadvantage could be limited profit potential. So basically your profit is capped and it won't be that high as if you correctly predicted a big stock movement. So in this strategy, you not only know what's your maximum losses, but you also know what is your maximum profit potential. So if you're a beginner, this strategy might sound extremely complicated. So that could be your second disadvantage. You need to have the understanding of option and you need to understand the market risks. Then only you will be able to execute this particular trading strategy. And the next thing is you need to monitor this strategy. So you need to keep an eye on the market, because if the thing starts to go south, then you might want to adjust this particular trading strategy. So let's have a quick recap on the strategy. So what is the strategy all about? This strategy is, so you're going to execute the strategy when you think the market is going to stay range bounded for a while, right? So in this scenario, these are the 2 ranges. So you're basically going to sell 2 out of the money options. In this case, you're going to sell 48,800 call option and you're going to sell 47,800 put option. Okay. After selling this 2 option, you're going to buy further out of the money options. So in this case, you're going to buy 49,300 call option and you're also going to buy 47,300 put option. So why are you buying the further out of the money options? Because to protect your capital, and by buying further out of the money options, this acts as a stop loss in this particular option trading strategy. So this was just an overview of the strategy. There are many different adjustments that you can do in the live market, which you are going to learn in detail in the upcoming videos.